Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. Sometimes it is a good idea to go back to the basics, and today I'd like to talk about balanced advantage funds in the context of what you're seeing and you have been seeing in the recent past. It's not been the best year for equities, and in that context, balanced advantage funds and other hybrid funds have actually done better when you compare them with pure equity portfolios. But at the same time, you have bond yields, and we'll explain this so that everyone understands it, that are unlikely to go too far down. And that means that the capital gains that you would get from fixed income portfolios are not very high. Sounds complicated? Well, that's because I'm explaining it. Let me get you Harsh Kumar, who's a partner at Zvest Financial Services, and I'm sure that he's going to explain it much better. Harsh, thanks so much for taking the time and for speaking to us on Your Money Matters. Let me first ask you, for those people that are unfamiliar with the concept, how do balanced advantage funds work and what is their purpose?
So, Alex, there are two categories in hybrid funds. One is called static asset allocation fund or aggressive asset allocation, and second is called dynamic asset allocation fund, which in popular terminology we call it as balanced advantage fund. Now, if I look back in the times, this category was made a distinct category by Security and Exchange Board of India in April of 2018. And most of the funds which have been launched in these categories were actually prior to that. Since 2012, we have seen a good amount of traction of these funds. And the inflows in these funds have been significant. So if I just see the current AUM of these funds as a category, that's around 3.2 lakh crore. Now, if I go back to the static hybrid category, the AUM there is around 20 to 25% lower, which means these funds are becoming mainstream as far as allocation is concerned. Now, what are these funds? These are the funds where there is a full flexibility with the fund manager to take equity exposure between 0 to 100. Though generally we have seen that there is a more moderate range in which fund managers operate, unless you have a situation like COVID where there is a sharp correction in the market and some funds would have gone as high as 75-80% also. But broadly, they remain in the moderate range. Now, how do they decide how much debt and equity to have? So they have all their proprietary models. There are certain variables which are fed into the proprietary model. These variables could be pricing multiples like price to earning, price to book. It could be certain momentum related variables. It could be even certain special situations which could be a part of capturing the sentiments, which can help decide how much debt and how much equity should be a part of the portfolio. Now, in this category, what we have seen is that the decision between debt equity percentage is generally automated, and fund managers don't have too much of a discretion there. But which bonds to buy and what equities to buy, that is a discretion of the fund manager. Now, there are two broader categories of these funds. One is called pro-cyclical funds, where if the market is trending high, the fund managers increase exposure to equity and vice versa. And then there are certain counter-cyclical funds where if the valuations are cheap, then equity allocation is increased, and the valuation is expensive, equity allocation is reduced. So you can say that balanced advantage funds are more like automatic car, where you don't have to worry about changing the gear, and when to move from debt, when to move to equity, and vice versa is decided by a team of expert. And they have been doing a very, very good job over last few years. One caveat here I would want to say is that the fund managers in this category, they have to maintain 65% allocation in equity or in arbitrage to ensure that the taxation is equity taxation.
And most people do that, right, Harsh?
Right. They do that because otherwise, one of the key advantages of these funds is tax efficiency, which goes away.
Yeah, just to drive home that point, a lot of people have stopped investing in pure fixed income funds since the government changed the treatment of these funds and the returns that you get from them with regard to the capital gains tax, right? You would be paying slab rate on all returns from these funds, irrespective of whether it is capital gains or interest income. And that is an important clarification, of course, that has caused a lot of people to shift their allocations. Harsh, you would know this. So therefore, what is the ultimate expectation on returns when you invest in a balanced advantage fund? What is the ideal time frame that you would want to keep or you should keep for a balanced advantage fund?
So, Alex, let's look at the data points to arrive at that number.
Okay.
Now, when I was saying that most of the funds got started after 2012, so we don't have a data for last 20, 25 years, but let's take the data for last 10 years. And in 2015, we had close to around 11 funds which were there in the market in this category. If I do a rolling 3 years analysis, there are two funds which had 4 to 5% negative instances of returns. And one fund was HDFC, another one was Bank of India. And here again, I would want to tell audience that HDFC Balanced Advantage Fund was not dynamically managed till around 21, 22. And that's when they started managing it dynamically. So it historically used to have higher equity allocation. And it was managed by Prashant Jain. When Prashant moved out and a new team took charge of this fund, they started managing it dynamically. So this could be the reason of that fund having negative reporting numbers over a 3 years time period. But even if I look at other funds, there have been 1 to 2% instances over 3 year rolling period where the returns were negative. Now we did the same analysis for 4 years, and all the funds had 100% instances of positive return. So if I'm advising someone that your principal would be protected, then going by historical data point, 4 year is the ideal time frame, or I would say the lower time period in terms of the holding period which an investor should have. Now let's come to the returns. If I look at returns over 3 years rolling, 4 years rolling, 5 years rolling, on an average basis, it ranges somewhere between 9.5 to 10%. And most of the fund houses, they tell that these funds are not relative return products, which means you don't compare it to Nifty large cap or mid cap or small cap, but look at it as an absolute return product. And these are all seasons products. So if you are looking at a return, going by historical data, though history is not an indicator of the future, but if you are okay with 9.5 to 10% kind of a return, and if your holding period is 4 years and above, then this is a beautiful category to be a part of your portfolio. And one more thing I would like to clarify here. Alex, you were saying that most of the people have started moving from pure debt funds to this category. That I would advise against. And I'll tell you the reasons for that. If I look at the volatility of this category in standard deviation terms, if you use the term, is between 5% to 17%, where funds like SBI Balanced Advantage Fund would have a volatility much lower at around 5.5%, while Nippon and HDFC trend at a higher level of volatility. So please don't consider it as an alternative of debt fund. There are other funds which are like debt plus arbitrage and income plus arbitrage, which you can look at for that space. But this should be looked as slightly aggressive variant than debt, but conservative than equity.
Okay, I just want you to explain very quickly, Harsh, that point for everybody that is not familiar and well versed with mathematics or investments. When you said standard deviation of 17% at the higher level, how do you explain that in the context of something, for example, that has a return of 10% compounded annual growth rate over a 5-year period? In that context, what is the meaning of a 17% reading on standard deviation?
So let me take a simple example to explain that. Let's say you are driving from your home to your office, and every day you are taking 20 minutes. One fine day you are rushing, you are late for your meetings, and you say that normally I drive at a speed of 60. Today, let me drive at a speed of 100. Maybe you will reach well ahead of time, but there is a small possibility that there could be accident on the road also, because you are not comfortable driving at that speed on a daily basis. So in financial terms, standard deviation means how much are you going away from the mean. So if I take a simple instrument like fixed deposit, if you're doing fixed deposit at 7% per annum for next 5 years, you know that on day one, your return is 7%. On day 10, your return is 7%. On day 100, your return is 7%. So you don't have any standard deviation because your return always is 7%. But funds where today's return could be 5% and tomorrow it could be 10 and day after tomorrow it could be 2%, that means they display a higher standard deviation, which means the behavior is not in sync with the mean. It keeps on going away from the average return.
Yeah, very well put. And a simple example in this case is that if you have gotten a 10% return, the standard deviation is 17 or thereabouts, there have been periods in that time frame when you have also gotten negative returns on that investment that you have got. So you need to be okay with that period of uncertainty and negative returns. But coming back to the point on balanced advantage funds, Harsh, you described certain behavior patterns or return patterns over the course of the last many years, and you actually looked at it in rolling returns terms. But I'm curious, you mentioned the overall assets under management. It's a pretty large category. What are the largest schemes and what is the return profile that they have generated?
So, Alex, this is a very, very interesting category. And why I say that, because in this, the leaders have the maximum share of AUM. So again, going back to my number of 3.2 lakh crore of AUM, the number one fund in this category in terms of AUM is HDFC. The AUM is close to around 1.05 lakh crore, which is 33% of the entire category's AUM. So you have 35 funds and one fund is 33% of the total AUM. Second fund is ICICI. The AUM is around 70,000 crore, followed by SBI at 40,000 crore. And then you have Kotak and Edelweiss at 17 and 13,000 crore. So if you take these top five funds, 77% of the AUM is with these five funds. Now, generally, you would believe, or the intuitive feeling is that when the AUM increases, then performance becomes a drag. But that's not been the case in this category. Let me illustrate with numbers. If I look at last 5 years, trailing number, not a rolling return, HDFC and ICICI have been the leader of the pack. If I look at last 3 years, HDFC, ICICI, and SBI has also participated in that. So these three have been the leaders. If I look at last 1 year, then the leader was ICICI, followed by SBI and ABSL. HDFC lagged a bit in last 1 year, but that's a very small time period to look at. If I look at these funds on which have delivered better return, most of these funds have been counter-cyclical. Over last 1 to 2 years, these funds have delivered better return. One reason could be that market was not in a momentum, market was very narrow, and funds which were following pro-cyclical approach, they lagged versus funds which followed counter-cyclical approach. But one thing is very clear. If I look at last 1 year return of ICICI Balanced Advantage Fund, which is the top fund in the category in terms of performance last 1 year, it is 12%. If I look at ABSL and SBI, the return is 10%. Now let's look at the return of Sensex. Sensex delivered 9% return. If I look at Nifty mid cap or the average of mid cap funds, the return was in the range of 4%. If I look at the average return of small cap fund, it was minus 4%. So I'm giving you a lot of data points, but the point I'm reiterating is that the asset allocation and risk management can deliver better return in times when the market is very range bound, when the market doesn't have a clear leadership, and that we saw in 2025 when these funds delivered much better return than full-fledged large cap, mid cap, or small cap funds.
Okay, so now here's the clincher and the end of the conversation. But Harsh, it's important to identify where this fits, because you can buy a Lamborghini, but then if you have to drive from Bandra to Borivali, then it may not make sense. So therefore, where does it fit in your portfolio? Who should buy it?
So first and foremost, Alex, like I mentioned earlier, the profile of this fund is moderate. It's not a conservative fund. So it's not an alternative of debt. It's not an alternative of income plus arbitrage. So one thing should be very, very clear, that you are getting into a fund which has equity, which has volatility. The average volatility, though, is around 9%, which is not very high, unlike small and mid cap funds. From a behavior point of view, if you ask me, investors who don't want to put their head on how much debt and equity they should have in the portfolio, it's good for them. Investors who are confused as to whether they should enter into the market today or tomorrow or after 1 month, what kind of valuation multiple they should track, it's a good category for them, because they can enter into this fund practically on any given day. Third category of investor is people who are hands-off investors, who check their portfolio once in a while. This is a good category because it will not disappoint you on the negative side. If you get into some other category like thematic fund or something, and if you don't track it diligently, you could have a very bad experience, even if you hold it for a longer period of time. Now let's look at the investor profile on which kind of investor should be getting into this. First-time equity investors, it's a good category for them. DIY investors can look at this space because you don't need to apply too much of a brain before getting into this. Investors who are going to retire in next 3-4 years and are looking for an anchor fund for systematic withdrawal plan, this is a very good category. And somebody who has a very important goal 4-5 years down the line, like goal of marriage or education, they can load their portfolio slightly higher toward this. And I would say that this is not a product which is not for everyone. It is actually a product for everyone, and it should be a part of core asset allocation for most of the investors. Returns, we have discussed that
Sure.
the expected return should be 9.5 to 10%, and a holding period should be 4 years plus.
Great. I think we've covered a lot of ground. Harsh, thanks so much for taking the time as always. Pleasure speaking with you.
Thank you, Alex. Thanks.